Nimesh joining into this conversation as well. Nimesh, you're looking at it more from a more granular stock lens. So tell us more.
Ekta, as she rightly pointed out, I can understand the kind of excitement which is there for this particular sector, whether it's power or power transmission lines or power grid companies. As Vinny pointed out, so many upgrades coming in and initiating reports coming in. Just to share, I was at the ISEC conference for the last 2 days, and the biggest excitement in that conference was in Hitachi's interaction. The entire room was packed. Every investor, every fund manager wanted to listen to the management of Hitachi. So that's the kind of excitement I can see on ground as well from investor community as to for this particular sector. But I just wanted to put out a couple of things. As Vinny pointed out, and that should come up on the screen as well, the rally which we've seen in these particular stocks in the last 1 year and Y2D and the kind of valuation they are trading at. Okay, and I just wanted to highlight, while we all, and we've seen this in the past as well, normally street gets excited towards the fag end of the rallies at some point in time. I'm not saying, the rally in power stocks and power grid companies is over. There is a big tailwind, but there are risks as well, which one needs to be cognizant about. And just want to, put this parallel to the kind of, excitement which was there in the EMS companies last year. Okay. There was massive rally in the EMS names, the Dixons, Ambers, Evlon, Cinema SGX. I think the 1 year charts are there. I still remember in Dixon, okay, last year I saw initiating report in Dixon at 19,000 rupees for a target of 20,000 from Nomura. And from there, the stock collapsed to half. Like it's almost at 10,000 rupees now. Similarly, Amber, Dixon, all have seen a decent correction in the last one year from the peak level. So, yes, there is a big tailwind for the particular sector. Yes, there is a massive orders which are lined up. But do keep in mind the kind of rally these stocks have seen and the kind of valuation these stocks are trading at. So at these valuations at 100 times or more than 100 times, the only risk is even a short slippage of execution and you will see massive de-rating on those names. So that's the only point I thought I should highlight for the viewers as well. Yes, there is a big momentum, but be watchful about the valuations as well. And they're sitting on very rich valuations at this point in time.
Absolutely. Nimesh, rich valuations, that's the concern, right? Let's also bring on board Rajesh Kothari, Managing Director at Alpha Accurate Advisors, joining us right now. Rajesh, good afternoon. Thank you so much for joining us. Nimesh also pointed out some risk coming, and that big risk that Nimesh right now highlighted, and it's a concern, right? You've seen that run-up coming in all these names, Hitachi Energy, CG Power.
Honestly, there is a specific reason we requested for Rajesh to join for the show. Rajesh, you've been very early in identifying this particular theme. In the last couple of years, you've been investing as well in the likes of Hitachi and a couple of other names. As an investor, guide us as to how should one look at this particular space, and should valuation be a bit of a concern at this point in time for investors?
Thank you, Nimish. Thank you, team. So thank you for inviting me. I think one most important thing in capital goods space is to not look at just profits and not look at just valuations. Most important for any capital goods space is to look at the incremental order book outlook. Correct? Say, for example, 3.5 years back when we bought, or 2.5 years back, June 2023, when we bought Hitachi, please put a disclaimer because we continue to own this name for our clients. It was trading at even that time 82 PE. From there, stock is up 12 times. Even today, it is trading at 82 PE. So what is important is to predict the business cycle. What is important is to not look at pure PE and pure PEG. That is basically the traditional tools for non-capital goods sector. In capital goods sector, what you have to look at beyond that? You have to look at the outlook over the next 3-4 years. So if you believe that the HVDC fresh order inflow will continue to remain very strong, not for next 6 months, but for next 2, 3, 4 years, then even from current valuations, you may still make reasonable money. How much money, that I leave it to somebody's expectations. But if you believe that the order inflow growth is going to stop, then definitely, even if you buy at lower PE, you will not make money. And that's how capital goods companies needs to be valued at.
Sure.
Because pure price to earning multiple will give you a wrong signal. In fact, if you buy any capital goods company at a very cheap PE, it means it's a trap.
Okay.
It means the entire execution is already into the numbers. So never buy 10 PE stocks in capital goods.
Okay.
That's a good advice,
Capital
actually.
goods, you are buying the orders. You know.
Absolutely.
Okay.
So order book and order backlog becomes important. While they all have these strong order books, Rajesh, I just want to understand your thoughts on the HVDC side, right? Some analysts highlight that there's a likely risk in terms of delays, or it could get potentially moved further, right, from FY27 to FY28. Then does that become a risk, at least in the near term? Or if the execution slips, then is there a risk on that front as well, right?
But absolutely right. It's just like, let me put it this way. Suppose somebody is investing into Indian equity market. What is the key risk? Key risk is the crude oil price. Suppose you are investing into US market. What is the key risk? Key risk is the interest rate. Similarly, when you invest into any capital goods company, be it a transmission or non-transmission, your key risk is the lumpiness. And that's the reason why companies keep saying in all the conference call, please do not monitor us on YOY and QOQ basis. Because it's a project commencement, execution takes time. At times there are delays, 6 months, 9 months delays are very normal delays for such a large projects. And that lumpiness at times creates opportunities because market do react negative 20% if there is some disappointment on some numbers. But if you believe into that story, because the company which right now we are mentioning, stock went down 40% in between. And nobody wanted to buy because somebody said, oh, what if the data center don't come up? But then from 8,000 rupees, stock is today 32,000 rupees. Yeah. So lumpiness is the risk in any capital goods business. 1 quarter, 2 quarters here and there, they are bound to happen. You need to take a much bigger call. Transmission capex is roughly about 3.5 trillion. HVDC I'm talking about, related to HVDC. And of that, I think equipment order size will be close to roughly about 65 to 70,000 crores. And add to that the exports, the international opportunity. And that's where the right to win the market share comes into play.
Yeah.
And please remember, when you look at the transformer, there are multiple segments, 765, 400 and 220. Yeah. And the moment you go to 700 plus, number of players are very limited in the world.
Yeah.
If you look at 220, there are thousands of players. Yeah. So you have to pay premium for that technology. You are paying premium for that market leadership. You are paying premium for their entry barriers. And then you need to forecast, do you think it is sustainable or not? Of course, and the risks will remain, as you rightly mentioned. Those risks are there.
Yeah. Rajesh, all points taken, and you've been tracking this space very long. You've been in the market for more than 20 years now. So I can understand as an investor how you look at this, this particular sector. But as you said, don't buy these companies at 10 multiple. Let me ask you the other way around. At 100 multiple, which are the key risks that as an investor one should be careful about? If you can list out 4 things that you as an investor will be watching out for very closely, not from a 1 quarter perspective, but from a 1 year perspective. Every con call, which are the few things that you will be tracking it very closely?
Ask me, the single most important factor is the incremental order inflow. That's the number what you need to track and monitor closely. Execution delays, let's assume 1 quarter get delayed, then it will come into the next quarter. So it doesn't make actually any difference. When you look at, even if there is an advanced execution, then the next quarter will be bad, correct? So
Rajesh,
those are the execution-related challenges.
Rajesh, got your point. First point, on incremental order, right? I got your point that one needs to monitor that. In that particular space, what could be the risk for, or what could be the, challenges, the risk for these particular companies? My sense is, my question is, what can go wrong? As an investor, what is that you'll be watching out for? What can go wrong for orders to not to come? Technology changes or environmental changes, what can go wrong for this if incremental orders don't come?
I think the biggest risk is the timing, the delay in giving the orders. Yeah. Because at times the feasibility report takes much longer time. And therefore, suppose somebody assumes that in 1 year, one project will come. And instead of 1 year, it happens in 18 months. And for 6 months, all of a sudden, you do not see any incremental order inflow. And market being market, it disappoints some investors. And therefore, you see the correction. So, important is, while the long-term track and everything looks solid, in what time frame you are expecting what order inflow? That is the most important factor to monitor.
Sure. Rajesh, other thing, in this particular space, while you said order inflow is important, how closely as an investor you monitor the margin profile as well? Is that a bit of a risk that you perceive going forward?
I do not see margin as a risk, Nimish, in particularly for such companies which are oligopolies. Definitely margins are going to be very high risk for the companies which are operating below 400 kV. because many of these projects, they take the fixed price contract. So when the raw material price goes up, your margins goes underwater. That's the problem. But moment you are into the higher end of the it, you have some pricing power, you have some escalation clause. So there might be 100 bits plus minus, but moment you look at the entire project size and the project duration, then margins are going to be in your favor because operating leverage starts coming in. So it depends which segment you are playing within transformer. Below 400, huge risk to margins. Above 700, low risk to margins.
Sure. Rajesh, before I let you go, last question. One, you must have seen the news about MTA Technologies. Bloom, who services them, they've lost one large order in the data center space. Similarly, we saw what happened to the EMS companies last year. Everybody was talking about Dixon and Ember and everything, and they've seen a big correction from the peak levels. How do you relate these kind of accidents for the power and power grid sector? Is there a learning that you would be implementing while tracking these companies very closely?
That's where the risk comes into play instead of the client concentration risk.
Okay.
Particularly for such large orders, one single order is determining your future growth, correct? These are not like multiple 100 orders. So if you don't get one order, or if some other competitor gets the order, then of course next order you will get, but one you may lose, whether it's company A or company B, and therefore there can be immediate reaction to the stock price. So these products and projects are very large. Unlike other companies, client concentration risk is very high, project concentration risk is very high. And hence we always say, have a portfolio approach. Once you have a portfolio approach, you are reducing that risk. So for example, the EMS company which you are naming, the one particular size of order, they were not able to get through because of the India-China related issues. If that would have been there, the earnings growth would have been much better compared to what we are seeing today. So I think stock price is the reflection of the earnings growth. EMS is a different story. Transmission is a different story. EMS is not a typical capital goods. There are different challenges when you look at EMS.
Of course.
Whereas when you talk about the transmission, that is a pure capital goods space. EMS is a different space because they are catering to the 7 segments. It is the auto, it's the consumption, it's the railways, it's the defense, it's the aerospace, it's the mobile. There are 8 segments. Yeah. The value addition is very low. Therefore, that gets reflected in margins. Yeah. And ROC at times are good, at times are not good, depending upon which company you are talking about. Yeah. The working capital intensity is completely different when you look at EMS companies. So I think let's not mix two. They both are completely different things.
Okay. Rajesh, thank you so much for joining us because this was very insightful for any investor in terms of what to look for capital good companies as well. How to look at apart from...
Because he's been holding in those names for so long, it was important to get somebody like Rajesh to guide us as to how one should look at this sector, how should look at this company.
Because normally it's just valuations that you see.
And he was so bold to say, don't buy any company at 10 PE. That's the wrong way to approach capital good names. So great insight. Only one thing, Rajesh, because you've been in the market, you've seen, you spoke about client concentration risk. Are you now seeing investor concentration risk in these companies? Everybody's looking to buy into these names. And I'm saying, why I'm asking you is because my personal experience at the recent conference, the most attended session was of Hitachi. Every person in the room wanted to learn about Hitachi and more and about this particular space. So are you getting the sense or a bit of discomfort in terms of higher investor concentration now in this entire space?
No, at least it has not yet happened because these companies are not like $1 trillion market cap or 10 lakh crore market cap. These are still anywhere between 1 lakh to 3 lakh crores kind of a market cap. Promoters' holdings are very high, generally speaking. And since the tailwinds are huge, you will not see easy selling by the fund. So whether it's investor A or investor B, people keep asking FI versus DI, for example. I don't believe it makes a difference. What is important is there earnings growth? Is there ROC? If you have good earnings growth, good ROC, irrespective of whether it is an investor A or investor B, stock will do well.
Got it.
And if you don't have these two, irrespective of who owns retail or FI, they will not do well.
Okay.
Good discussion.
Rajesh, thank you so much for joining us this afternoon, talking to us about all of it in terms for EMS side, capital goods side, how investors should look at these plays as well. So thank you so much for joining in. Nimesh, thank you so much also for giving us this insight and taking us through that conversation as well. Thanks so much for that, Nimesh. But